Picture this. Chelsea opens her banking app on a Tuesday. She has exactly $41,000 sitting in her account. She scrolls right past the one line she has never actually read. Interest earned last month, 34 cents. Now, her friend Silas has the exact same $41,000. But last month, his account paid him $143. Same access to his cash, same insurance, same risk. Yet Silas made over 400 times the money. Nobody broke a rule here. There are no hidden fees and nobody buried anything in the fine print. The whole system works because your bank knows something about you that you don't even know about yourself. They know exactly how long you will leave your money sitting there before you get around to moving it. For the average American, that number is 19 years. 19 years in the same account at the same rate for the same 34 cents. Today, we are finding the actual mathematical maximum amount of money you should ever keep in the bank. Not the number your bank wants you to have, and not the number your uncle yells about across the dinner table. The real one. Because when it comes to keeping cash in the bank, there are two separate ceilings. Almost everybody worries about the wrong one, and it is costing you thousands of dollars. Stick around to the end, because I'm going to give you one specific question to ask yourself tonight that will fix this in about 11 seconds. Let's define the problem. When people ask how much they should keep in the bank, they're usually asking about one famous number, $250,000, the FDIC limit. That's the high ceiling. It matters. It's messy, and we'll take it apart in a few minutes. But the other ceiling is the low one. Nobody puts this one on a poster, but it's costing you money this exact month while you sit there feeling financially responsible. Let's look at the math. Over the last year, inflation ran at about 3.4%. Meanwhile, the three biggest retail banks in America pay 1/100th of 1%, 0.01%, on their standard savings accounts. If you have $10,000 sitting in one of those accounts, they are paying you a single dollar a year. You would literally do better checking your couch cushions. The couch pays you more regularly, and it doesn't even require a minimum balance. When you hold those two numbers next to each other, 3.4% inflation and 0.01% interest, that isn't just slow growth. That is a guaranteed annual loss of your purchasing power, delivered right on schedule via a friendly mobile push notification. This part breaks people's brains a little bit. Your savings account can be 100% safe and still lose you money. Safe just means the number on your screen never drops. It says absolutely nothing about what that number can actually buy at the grocery store.
Why is the gap so massive? Because your bank is not a vault. Your bank is a spread business. You hand them $1, they pay you almost nothing for it, they lend it out for mortgages and car loans at a much higher rate, and they keep the difference. This is called the net interest margin. Across the industry, it's a little over 3%. So on Chelsea's $41,000, her bank is earning well over $1,200 a year. Her cut is $4. That is not a financial partnership. That's a parking garage. Let's take Chelsea's $41,000 apart, line by line. Let's say she spends $3,400 a month on living expenses. 2 months of expenses in her checking account puts her at $6,800. That's bucket number 1. Fine. Next, she wants 4 months of emergency savings. That's $13,600. In her traditional bank account at 0.01%, it earns $1.36 a year. If she moved it to a high-yield savings account paying around 4.2%, it earns $571 a year. Same money, same daily access, same government insurance. Run the subtraction. $6,800 plus $13,600 is $20,400. Chelsea has $41,000, which leaves $20,600 with absolutely no job at all. This is the number that matters, not your total balance, but the part of your balance with no assignment, no deadline, and no reason to be there. Watch what happens to it. If she leaves that $20,600 alone for 20 years at her standard bank rate, it grows to about $20,640. 20 years, $40. If Silas puts that same amount in a high-yield account at 4.2%, it becomes about $46,900. That is a gap of over $26,000. And remember, because of inflation, Chelsea's $20,000 in 2 decades will only buy what about $10,500 buys today. Her statement never showed a loss, but she ends up with half the purchasing power she started with. Nobody scammed her, she just left it somewhere. Chelsea isn't lazy, she did the hard part. She saved the money. But roughly 82% of Americans don't use a high-yield savings account. The number one reason isn't distrust. It's that they didn't know, or it seemed like a hassle, or they just meant to get around to it. Now let's talk about the famous ceiling, the $250,000 FDIC limit. Let's introduce our third character, Lauren. Lauren has $400,000 sitting in a single account at a single bank right now. Is she doing something wrong? To answer that, we have to look at what FDIC insurance actually is. The exact legal phrasing is the whole ballgame. $250,000 per depositor, per insured bank, per ownership category. Most people hear the first part and stop, but the difference between understanding this and half understanding it is the difference between being covered and losing everything. Per depositor means you, the human, not your account.
Per insured bank means the institution itself. Per ownership category, this is the magic phrase, because there are 14 of them, and they stack. If you are married, you and your spouse at one bank can be covered for $250,000 in your individual account, $250K in theirs, and $500K in your joint account. That's $1 million of protection at one single bank. But here is the mistake that costs people. Opening a second savings account in the exact same category at the same bank adds 0 additional coverage. Your balances just get lumped together against that one $250K limit. 2 buckets, but only one ceiling. Does this actually matter, or does the government always just step in and save everyone? In March 2023, Silicon Valley Bank went down in the fastest bank run in American history. According to the Federal Reserve, roughly 94% of that bank's deposits were uninsured. 94%. Entire massive companies had hundreds of millions of dollars stuck there over a single weekend. Companies couldn't make payroll. People panicked. The FDIC ended up making everyone whole through a systemic risk exception. But regulators said out loud, do not plan around this happening again. So what about Loren and her $400,000? Loren is closing on a house in 6 weeks. That money has a job and it has a deadline. It absolutely cannot be invested in the stock market because a bad month in the market would cost her the house. Her cash is a tool. So what does she do with the $150,000 that sits above the insurance limit? She simply splits it across 2 banks or uses a joint category with her spouse. Problem solved. All right, we've covered the traps. We've covered the limits. Now, let me give you the exact rules, the ultimate blueprint for your cash. It all fits on an index card. Rule number 1, 2 months. Keep exactly 2 months of your living expenses in your standard checking account. If you spend $3,400 a month, keep $6,800 in checking. Why? Because this is your shock absorber. It's enough to handle a weird bill or a bad month without you ever stressing or overdrafting. Rule number 2, 3 to 6 months of your essential expenses. Keep 3 to 6 months of your essential expenses in a high-yield savings account, a money market fund, or treasury bills. Pro tip: if you live in a high-tax state, look hard at treasury bills because that interest is exempt from state and local income tax. This is your emergency fund. It is highly liquid, but it is actually fighting inflation for you. Rule number 3. The $250,000 ceiling. This is your absolute hard cap per bank, per ownership category. Never leave more than this sitting unprotected.
Rule number 4. The 5-year horizon. Any money that has no assigned job for the next 5 years or more does not belong in a deposit account at all. Leaving long-term money in cash means you are choosing a guaranteed slow loss to avoid a temporary possible loss in the stock market. You would never take that trade in any other area of your life. Now, are there exceptions? Always. If you have a variable income, if you're a freelancer or the sole earner in your house, keeping 9 to 12 months in cash is completely defensible. If you're retired, keeping 1 to 3 years in cash prevents you from having to sell stocks during a market crash. You know your volatility better than any YouTube video does. But for the vast majority of us, that 2-month checking, 3 to 6 month saving split is the golden rule. The reason Chelsea and Silas ended up tens of thousands of dollars apart has nothing to do with intelligence, income, or discipline. They saved the exact same amount. Chelsea treated her bank account as a place where money lives. Silas treated his as a place where money passes through. That is the entire difference between them. And it is the one thing you get to change today, from your couch in about 11 minutes. 19 years is a long time to be loyal to an institution that was never loyal back. Quick disclaimer: I'm not a financial advisor. This isn't financial advice, and interest rates constantly change, so check current figures before you move anything. But here's the question I promised you. Tonight, open your banking app. Find the line that says interest earned. Look at what last month actually paid you. If that number is smaller than the cost of a cup of coffee, you now know exactly why. You know it wasn't a mistake. It is a ceiling, and you are the only one who can raise it. If this video helped you rethink your money, hit that subscribe button. It helps the channel immensely. Take control of your cash this week, and I'll see you in the next one.